Hi, I'm Christian with Plan Your Federal Retirement, back with another video with our Critical Concepts series. Critical Concepts is a new series we're working on where we're looking at different videos online or different articles that we're seeing, or maybe even conversations we're having with our own clients that they'll say something or they'll mention something that they've heard or will see that maybe has some half truth to it, or maybe there's just some blatant missing information or wrong information. So we're looking at it from a critical lens on these different concepts to make sure that you guys don't make critical mistakes. And recently I was looking at an article having to do with just a high-level overview when it comes to the TSP, and it did a really good job talking about it. And in particular, it's going through the different investment options between the G fund, the F fund, the CS and I funds, and it even mentions a life cycle fund. Now, life cycle funds, I'm sure you guys are aware, they are depending on the date of the life cycle fund. So for example, an L2030 fund coincides with retiring in 2030. So the concept is it's going to take a mixture of the 5 core funds, G fund, F fund, C, S, and I funds, and depending on the date that you have that L fund, that's how it's going to be invested. So the concept being the closer you are to your retirement date, the more conservative that investment is. This article mentioned that the funds automatically adjust their asset mix of stocks, bonds, and government securities as you approach retirement, becoming more conservative over time. Each L fund is designed for a different target retirement date. And this is common even outside of the TSP, right? Different target date funds. So the one thing I like to say when it comes to target date funds and the L funds in particular is they will oftentimes get too conservative a little too quickly. So for example, I'm on the TSP websites right now and I'm looking at their L2030 fund. So this would say, okay, we're going to retire in 2030, which is 5.5 years away. We're looking in 2024 right now as we're recording this. And the L2030 fund currently is invested 34.03% in the G fund, government securities fund, very safe money, and 5.85% in the F fund, which is fixed income or bonds. So just shy of 39% of the money being invested in cash and bonds. And then the rest is split between the C, S, and I funds. Okay, so we're within 5 years, or a little over 5 years away from retirement in this L2030 fund, and about 40% of our money, 39% and change, is in stocks and bonds. Maybe that's the right mix for you. Maybe it's not. Maybe it's a little conservative. Let's look at the L2040 fund. So this says we're retiring, hypothetically in the year of 2040. And the TSP website right now says the G fund has 21.15% in the G fund, and the F fund has 7.1% that's in the F fund, and then the rest between C, S, and I. So that's somewhere around 28% that's in cash and bonds combined. And this is 15 years away, or the idea would be you're retiring in 15 years from now, 28% of your money is in cash and bonds. This could be the right option, and I'm not giving you investment advice over this video. We really got to look at your individual situation. You got to consult with a financial advisor like myself or someone else from our team to see what's the right investment mix for you. But it's possible that you're just thinking, hey, I'm going to put my money in this target date fund because that's the year I'm going to retire. Makes sense. Gets more conservative over time. I like that. But it could be that, it's just getting too conservative too quickly, and it can get a hold of you or potentially missing out on those potential returns that we could be experiencing. In particular, I'm picking on this L2040 fund. Well, that's 15 years away. Could we argue that the money that we're going to be investing over the next 15 years, if we had a little bit more focus on money being invested in the stock market, could earn us a bigger rate of return? Yeah, absolutely. But obviously that comes with more risk. So there's checks and balances to it, and we just, again, have to be mindful that those L funds can be a good option, but we can't let them sneak behind us and get too conservative too quickly, and now it's too late to have lost out on all this potential returns that we could have had. So hopefully this is helpful. Make sure you're subscribed to our channel so you get our latest videos and content that we're putting out. Make sure you leave a like on this video, as that always helps. And if you have a particular question that you would like answered, you can feel free to drop that in the comment section below. And as always, until next time, happy planning.